The latest news out of the Federal Open Market Committee is that they're going to lop another $10 billion off the quantitative easing, or QE, program. That's the fourth consecutive cut we've seen in a row for the Fed, and it leaves QE running at a pace of about $45 billion right now. Now, when you look at what the FOMC officials had to say about the economy, they were generally upbeat about things, noting that growth has picked up recently. They're positive on household spending, although they did note that business fixed investment and housing remain somewhat sluggish. So all in all, it seems like a Fed that continues to be on autopilot when it comes to cutting back on QE, and it's likely that the program is going to go away entirely by this fall. I think if you look at what the Fed's medicine is for this economy, it's clearly not curing what ails the patient. We've had something like a $4 trillion Fed balance sheet now as a result of more than $3 trillion in money printing over the last 5 years. And what have we gotten for it? An economy where GDP grew just 0.1% in the first quarter, the slowest since the fourth quarter of 2012. And we continue to see that while free money is helping out Wall Street wired banks and investment firms like Blackstone Group, and helping to inflate an echo bubble on housing, it's not doing much for Main Street. It's not helping promote real job growth. So I think what you're seeing, again, is an economy that is not responding to Fed stimulus, yet we've continued to hear calls from other people to increase the Fed stimulus, or in other words, give more of what has not been working. I think what the Fed needs to do is not only get out of the QE business, but start normalizing interest rates. We've put more than 5 years between us and the credit crisis, the depths of the recession, so there's no need for crisis-era policy anymore. I think what the Fed is doing is hindering the economy by keeping rates too low. Corporations are just taking this free money, borrowing at ultra-low interest rates, and they're not building factories, hiring workers, or boosting capital expenditures. Instead, they're buying back stock and acquiring competitors. That's good if you happen to be a shareholder of a company that gets bought out, or a shareholder of one of these companies whose share base is shrinking, but it doesn't do anything for mainstream America. In short, Greenspan's policies were an epic disaster, helping inflate huge bubbles in tech stocks and housing. And Ben Bernanke's solutions, not to mention those that Janet Yellen is continuing to promote, are not working, no matter what the Fed apologists on Wall Street say. This has been Mike Larson from Money and Markets. Thanks for listening.